Hey everyone, today we are doing behind the scenes of one of the most important, essential institutions in the world, banks. How do you deposit money? What happens to the value of that money? What is risk for the banks? How do they really contribute in an economy? Apart from giving loans and giving benefits to people, what all different aspects the banks play in modern economy? So we'll be covering these topics. Whether you are shopping outside, whether you are swiping your card somewhere, the banks play the most important role in the cash transfer. If you're purchasing in a mall, if you're buying a car, if you're taking a loan, banks are the most essential units that exist. But there are very high chances that you aren't aware of how these banks work and operate, how these banks fight risk and create value in the economy. We'll be looking at specific topics on how these banks work, their purpose, how they generate money, their special rules, regulations, risks, all the innovations and future stuff that the bank might look like. So let's understand why these banks exist. What is the purpose for the existence of these banks? For example, if you're doing an odd job, any job that you are doing, and out of that job you are earning some money, what do you think you're going to do with that money? Will you be able to use it readily when you need it? Probably not. There are also major problems like damage, theft because of the money that you've earned. Now imagine in this situation someone comes up to you and say, you can give me that money and I will keep that money safe for you, and whenever you need it, and you can use that money whenever you want. That is known as bank. So bank serves three functions. First is safety of your money. When you're depositing your money, the bank assures safety. The bank reassures you that your money is safe with the bank. Number two is liquidity and convenience. The bank also assures you that you can pay and you can withdraw your money whenever you want. It doesn't matter what time it is, you can withdraw and pay to anyone whenever you want. Number three, intermediation. You can use the help of banks to pay for someone else's project, like giving them out loans. And that is how the banks connect savers from borrowers. So in short, the bank will borrow the money from the people who have that money in excess and give that money to the people who are in shortage of that money in the form of loans. This is known as financial intermediation. So if you go online and search the basic definition of banks, the banking systems are the institutions who are providing the financial services like payment gateway, giving out loans, taking deposits. This is the definition, you can find it online. The banks derive their profit from the difference between the interest rates paid and the interest rates charged. So these banks say to you, we give you storage, we give you safety, we can lend you money whenever you want. To the borrowers, the bank will say, we can get you access to the funds you don't really have at the moment. And to the society, the bank will say that you can use these funds to build your homes, your societies, your businesses, your jobs, everything. In the ancient times, the people used to store their valuable items into the temples or trusted depositories. But in the present era, we call these things as banks. There's not much difference between the two. Only the ease of access and services are the only difference between these two scenarios. So now you may ask, how these banks generate their money realistically? So let's see how these institutions actually do this thing. So for an instance, if you go to a bank and you deposit $1,000, the bank will not just keep that money idle. The bank will not do that. What the bank will do, the bank will lend that money out in the form of loans to the borrowers, and these borrowers will be charged some interest rates by the bank, and these banks will pay you, the person who have saved the money in the bank, small percentage of the interest. That is why in the most cases the bank will have its own reserve. A big chunk of money has gone out of the banks in the form of loans, whether it is businesses, personal loans, education loans, home loans, any form of loans. There is an interesting mechanism called credit creation. Even though you deposit $1,000 in the bank account, the bank may lend out that money in the form of loan. For example, the bank has lent $2,000 to the borrower. This $2,000 spent will be deposited again, for example, in a different bank. So altogether, what the result will be, the original deposit will lead to more of total money that existed in the system. So this is how the cycle will be: depositing, lending, then depositing and lending, and this cycle carries on. For example, if the banks are only keeping 10% as their reserves, so you are going and depositing $1,000, and 10% of the $1,000 is $100. $100 will be kept by the bank in the reserves, and rest of the $900 will be lent out in the form of loans. The next bank will receive this $900 as the deposit. It will keep 10% for itself. That will be $90. This $90 will be kept for its own reserves, and the rest of the money will be lent out in the form of loan again. This effect is called money multiplier effect. This is a very simple model, but it will help you to understand how these banking systems actually work in real life. So now you might be asking, if the bank is lending out, then how is it promising you can withdraw that money whenever you want? That's where the liquidity management reserves actually come in play, and also trust in the system. The banks will always have small reserves for itself that will have the cash flow. A fun fact: not all banks will deposit and give you loans. Some of the banks will make payment gateways, all the payment infrastructure. They manage the risks and will act like agents or a mediator. So next up, we will be looking at the functions, the core functions of the bank. So the banks have two types of functions: the primary functions and the secondary functions, which is also known as ancillary functions. So the primary functions or the core function. So what does this include? Number one, accepting deposits, saving accounts, current accounts, fixed deposits. Number two, granting loans, whether it is personal loan, business loan, home loans. Number three is credit creation, which we have already discussed. These are the core functions of these banks. Moving on to secondary functions of these banks. Number one is agency services. They'll give you platforms like online payment, like managing securities for the customers. Number two, utility services, NEFT, RTGS. All these services will be under the secondary function of these banks. Number three is payment infrastructure, which we have already talked about. Number four, financial advisory, wealth management, foreign exchange services. These are also included in the secondary function of these banks. So let's look at personally. You log into your banking account, your banking application that the bank has provided to you. You pay bills through that application, you withdraw cash, you make payments, you may get a loan to buy a bike or a car or a house. So these are the services, different types of services that these banks will provide to you in one way or the other. After understanding these things, let's look at what are the different types of banks. So different types of banking is retail banking, which is for personal or individual; commercial banking, which is for businesses. Thirdly is investment banking for capital market. And on top of all these banks, there is a central bank, which is the regulator for all these banks. And all these three types of banks will play different types of a role in sustaining the economy of the country. So by now, we have a good picture of the actual purposes of banks, how these banks generate their own money, what are the different types of banks, how these banks play important role in deposits and loans, and all these things will contribute in the large part of the economy. So now let's understand what is the central bank. We've heard that central bank regulates all the three types of banks: personal banking, commercial banking, and investment banking. So let's see what the central bank actually does and how the central bank manages its own risk. The banks are very important in our economy. We all know that. We have been discussing till now. But the major part in all this scenario is risk they carry. If all the depositors in the country make up their mind and they go to the bank and they ask for the withdrawals, or many loans go bad, then the banks will run into trouble, big troubles. That's where both the regulation and the central banks play a very important role. There are very different types of requirements. Requirement number one is reserve requirement. So all these types of banks will be required to hold the cash with the central bank to ensure liquidity in the system. That is very, very important. Number two, the banks must have enough equity capital to absorb the losses. Number three is supervision and deposit insurance. In this, the central bank will monitor all the other banks. The central bank will monitor all the other banks and will ensure and guarantee the depositors that they can deposit the money in the banks so that the depositors will not panic in the future. The Federal Reserve is the central bank in the US. main functions are issuing the currency, monetary regulations, and supervising the banking. For instance, if a situation breaks out and the people lose their faith in bank, the people will rush to the banks and for their withdrawals. But the bank has already lent that money in the form of loans. The bank will not be able to return the money of all these people simultaneously. So this is where the central bank will regulate and prevent this thing to happen, because trust is key. And that is why central bank will play a major role in preventing these types of situations. In this modern era, financial risks are extravagant. Digital banking, cyber threats, liquidity risks, all these risks can affect the performance of these banks, and the failure of one bank can cause ripples in this system. And that is why the financial regulations are complex. So the banks are not piggy banks, which you might think at one point. These banks have so much responsibility, so many regulations to follow, and they are deeply embedded in the economy. It's a very, very complex institution overall. If all these risks are so extravagant, how our future is going to be secure when we're talking about the banking systems and how these regulations are being enforced? So let's see some innovations and trends that we have already seen at the moment in this era, and we might see in the future as well. Number one is digital banking and fintech. Everyone has used the online payment. Every single day, these banks are being challenged by these fintech firms, these mobile payments, digital-only banks. So the way the banks are providing the services has changed over the years. Number two is money creation controversy. Some economists are arguing that the banks are not simply lending out the deposits. What the banks are doing is printing new money, is creating money while they are granting loans. So if you go online and read about this controversy, you'll be able to understand more about this. Number three is fractional reserve banking, which we have already discussed, how the banks keep a fraction of money for themselves so the cash flow will not be interrupted. Number four, alternate models. At this moment in 2025, we have seen so many cryptocurrencies, crypto blockchain systems, peer-to-peer lending, decentralized finance. But the question is, could these methods actually change the traditional banking? Maybe. So let's see what are the takeaways in this video about banking. Number one, the banks exist to provide you with safety, liquidity, and intermediation. Number two, credit creation. The banks are also responsible to manage their own risks and uphold the economy in a positive way. Number four, they operate within the larger system of these regulations under the central banks, and they're also responsible to stabilize the money supply. Number five, the banking world is evolving with technology. More of the banking systems are going digital, and in the future, everything will be digital. So these are the things that we have understood and discussed in this video about how these banks work and everything. So if you have received any insight from this video, do give this video a like and subscribe to this channel. I'll be posting so many different videos in the future, and I do hope that most of the videos will be relevant to you as an individual. Do share in the comment section your views regarding the same. I'll see you in the next